Welcome back to the channel. I'm really glad you're here today because this video is for long-term investors who care about income, consistency, and staying disciplined, even when the market narrative feels discouraging. As we move toward the closing chapter of 2025, there's been a lot of debate, frustration, and even disappointment surrounding one particular ETF that many income investors hold close to their hearts. SCHD, the Schwab U.S. Dividend Equity ETF. If you've been watching its share price this year, you already know why emotions have been mixed. SCHD hasn't delivered the kind of price appreciation that some investors hoped for, especially when compared to other popular dividend growth ETFs like VIG or DGRO. And yet, despite that underwhelming price performance, SCHD has quietly continued doing exactly what it was designed to do: generate growing income. Today, we're going to break all of that down in plain language. No charts, no on-screen visuals, no complicated graphics, just a clear spoken explanation you can follow from start to finish. We'll talk about what went wrong in 2025, what SCHD actually did well, how its dividends stacked up against competitors, and most importantly, what 2026 might look like for income-focused investors. So grab a coffee, settle in, and let's take a deep dive into SCHD, what it is, what it isn't, and why it still matters. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. As we approach the end of 2025, one thing is hard to deny. From a pure share price perspective, SCHD has been a disappointment. There's no sugarcoating that. If you simply compare the price movement of SCHD to ETFs like Vanguard's VIG or iShares DGRO, SCHD has lagged behind for most of the year. Now, to be fair, SCHD did show some signs of life in the final couple of months of 2025. There was a modest recovery and momentum improved slightly as the year came to a close. But even with that late-year bounce, SCHD still finished behind its peers when measured strictly by price appreciation. For investors who focus primarily on portfolio value and unrealized gains, that underperformance can be frustrating. It can feel like holding SCHD means missing out while other funds seem to be moving ahead. But here's where perspective becomes critical. SCHD was never built to win a race based on share price alone. That has never been its mission. SCHD is fundamentally an income-first ETF. Its primary goal isn't to deliver explosive growth or beat the S&P 500 in bull markets. Its purpose is to provide reliable, growing income through dividends, year after year. That distinction matters because when you judge SCHD by the wrong metric, it will almost always look like it's underperforming. If your main objective is dividend income, especially income that grows over time, then 2025 tells a very different story. Despite its lagging share price, SCHD delivered something extremely important this year: strong, consistent dividend growth paired with an attractive yield. In fact, when you compare SCHD to other dividend growth ETFs, its income profile in 2025 was arguably the strongest of the group. So while price-focused investors may feel disappointed, income-focused investors had a very different experience. Let's talk about the most concrete evidence of SCHD's strength: its dividends. After the market closed on December 9th, SCHD announced its final dividend distribution for 2025. The fourth quarter payout came in at 27.82 cents per share, adjusted for the ETF's split that occurred more than a year ago. This wasn't just another quarterly payment. It was the largest single dividend distribution in SCHD's history. That final payout pushed SCHD's total dividends for 2025 to $1.0476 per share. Once again, this marked an all-time record for the fund. In a year where the share price struggled, SCHD still managed to deliver its highest annual income ever. That's not something that should be overlooked. According to Schwab's own data, SCHD remains the highest-yielding dividend growth ETF among its major competitors. At current levels, SCHD's yield sits above 3.8%. Compare that to Vanguard's VIG, which offers a yield closer to 1.5%. That's not even in the same conversation for investors who rely on income. DGRO does slightly better than VIG, with a yield around 2.14%. That might appeal to investors looking for a balance between income and growth, but it still falls well short of what SCHD provides. The takeaway here is simple. If your goal in 2025 was income rather than capital appreciation, SCHD clearly came out ahead. One of the most impressive aspects of SCHD's performance this year is that every single distribution paid in 2025 was higher than the one before it. That kind of consistency matters. It reinforces the idea that SCHD isn't chasing trends or reacting emotionally to market noise. It's executing a strategy that prioritizes cash flow reliability and long-term income growth. Compare that to VIG, which experienced a much more uneven year. VIG started 2025 with a strong payout in January, but then followed that up with 2 consecutive quarters of dividend reductions. That's something VIG hadn't done since 2019. At the time of recording, VIG had not yet announced its final dividend for the year. Historically, Vanguard tends to announce that payment just days before the new year begins. If that final distribution also ends up being lower than the previous one, it would mark the first time in a decade that VIG reduced dividends 3 times in a single year. DGRO, to its credit, had a solid year for dividend increases. However, when you zoom out and look at long-term growth, DGRO still lags SCHD by a meaningful margin. At this point, a clear conclusion starts to emerge. If you are someone who wants to live off your portfolio's income, either now or in the near future, SCHD remains one of the most compelling options available. Compared to what Vanguard, iShares, or State Street currently offer in the dividend growth space, SCHD continues to dominate when it comes to income generation. Other ETFs may outperform in terms of share price appreciation, but income investors aren't paying their bills with unrealized gains. They're paying bills with cash distributions. That's where SCHD shines. One argument often made in favor of funds like VIG is that they allow investors to sell shares for income, supplementing smaller dividends with capital gains. But this approach comes with a major downside. Every share you sell reduces your future income potential. Fewer shares mean fewer dividends, which means you'll likely need to sell even more shares later on. Over time, that can create a negative feedback loop. SCHD's higher income reduces the need to sell shares in the first place. That's a huge psychological and financial advantage, especially for retirees or anyone planning for early financial independence. Some SCHD alternatives do offer broader diversification, and that can be appealing on paper. But diversification alone isn't a reason to abandon a strategy that's working. SCHD's focus is intentional. It doesn't try to be everything to everyone. It targets companies with long dividend histories, strong fundamentals, and reliable cash flows. That discipline can lead to periods of underperformance, but it also creates stability. Now let's turn our attention to the future. One of the simplest ways to estimate what SCHD might pay in dividends in 2026 is to look at its historical growth rate. By analyzing past distributions, we can calculate the compound annual growth rate, or a CAGR, of SCHD's dividends. Using data starting from 2012 excluding 2011 due to incomplete distributions, we can calculate the average annual growth of SCHD's dividends over a 13-year period. When you run the numbers, SCHD's dividend CAGR comes out to approximately 10.99%. That's an impressive figure, especially when compared to other dividend growth ETFs. If we apply that growth rate to the $1.0476 paid in 2025, we arrive at an estimated $1.27 in dividends for 2026. Of course, this is just an estimate. Actual results could be higher or lower. One major factor that could influence SCHD's future performance is its annual reconstitution. Each year, SCHD updates its holdings based on strict criteria. Companies must have at least 10 consecutive years of dividend payments, meet minimum market capitalization and liquidity requirements, and score well on several fundamental metrics. These metrics include cash flow relative to debt, return on equity, dividend yield, and 5-year dividend growth. SCHD does not include REITs, BDCs, or alternative income investments. It also does not prioritize companies based on expected share price gains. That means SCHD naturally leans towards certain sectors, financials, utilities, and consumer staples, among others. One of the biggest challenges for SCHD in 2025 was its exposure to energy stocks. Energy companies had a fantastic year for dividend increases in 2024, which led to greater inclusion in SCHD. But 2025 brought significant pressure to the sector. As yields in the energy space declined, SCHD's exposure may become less attractive under its own rules. Consumer staples, on the other hand, began offering higher yields in the latter half of 2025. This could lead to a shift in holdings during the next reconstitution. If SCHD reduces energy exposure and reallocates toward more stable, income-friendly sectors, that could support both dividends and share price in 2026. No matter what happens next year, the most important thing investors can do is remain committed to their strategy. SCHD is not designed to win every year. Some years it will lag in price, other years it will outperform. But if your goal is high current income combined with strong dividend growth, SCHD continues to execute its mission effectively. Short-term price movements matter far less than long-term income consistency. Let's wrap this up. 2025 was not a great year for SCHD's share price. Compared to VIG and DGRO, it clearly lagged behind in price appreciation. But when it comes to what SCHD is actually built for, dividend income, it delivered one of its strongest years ever. Record dividends, consistent growth, a yield that far exceeds competitors. Looking ahead to 2026, SCHD appears well-positioned to continue growing income, especially if reconstitution shifts the portfolio toward more stable, high-yielding sectors. If you value income, discipline, and long-term consistency, SCHD remains a powerful tool in your investing toolbox. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit